I know you wrote a Bloomberg View column just moments ago saying that this is a green light by the Fed. Are you 100% certain? How certain are you?
So if the meeting were next week, I would be near 100% certain. You never want to say 100%, you say 99%.
Right.
Because we still have 6 weeks, things can happen. But fundamentally, Betty, this report, which was comprehensively strong, gives 3 consequential messages to the Fed. 1, job creation remains strong, the unemployment rate is lower, and guess what? Wages are going up. 2, with the participation rate unfortunately not moving from this almost 40-year low, it tells the Fed there are structural issues. It's not all cyclical, and therefore monetary policy cannot be the answer. And then finally, with the rather muted stock market response, yes, we're down, but remember, 10-year yields have moved 9 basis points, and a lot of people would have thought stocks would be down even more. With the rather muted stock market reaction, it tells the Fed, you know what? You can be cautiously moving forward. So if the meeting were next week, 99%. Because the meeting is in 6 weeks' time and things on the international side could get complicated, I would reduce it to what the market has priced now, which is 70%.
Right. So certainly a clear majority, Mohamed. It seemed like almost every economist out there did not project something this strong. So is it possible this might be an aberration here?
Yeah, I think what's more of the aberration is what happened previously. So if you look at the path of job creation, they've been really steady. Yes, the annual average has come down. We're more just above 200,000 as opposed to much more. But you'd expect that as we create more and more jobs. So the labor market has been a story of steady and consistent healing. And it varies from month to month. But I think that is the constant story. The new element is wages are finally moving. And you and I have discussed this in the past.
Right.
And you'd expect wages to move because slack is being taken out of the labor market.
Well, speaking about wages, is there some concern that perhaps now we have finally seen wages tick up, it could get out of control?
Yeah, I don't think it gets out of control. I think you get a slight pickup in wages, but we're not anywhere near getting out of control. There's simply too much competition out there for it to get out of control.
How about the stronger dollar? Do you worry about that impact on the economy, Mohamed?
So there are 3 implications from not just what the Fed is likely to do, but the fact that the ECB is going the other way. So I am among those who expect the ECB to press even harder on the stimulus accelerator, and it will extend beyond September its QE. So the key issue is that divergent monetary policy is back. So there are 3 implications. 1 is a stronger dollar, and we've seen it happen. 2 is a bigger differential between U.S. rates and German rates, and we're back over 160 basis points, and we'll probably get back to 175 basis points for the 10-year. And 3 is the return of higher equity volatility. So these are the 3 consequences of not only what's happening here, but also what's happening in Europe.
You make a great point, right? So we've got this widening gap here between, Mohamed, not just the U.S. and the ECB, but it's the U.S. and the BOE and the U.S. and the Bank of Japan and the U.S. and the PBOC. Right. We're alone here in the world. What are going to be the consequences in the next 12 months?
So short term, the consequences are going to be, as I say, stronger currency,
right,
higher rates in absolute and relative terms, and more stock market volatility. It is the longer term questions that are hard. And I published an FT article earlier this week. These are big questions because you cannot disconnect the U.S. forever in this very interlinked world that we live in. So either the U.S. is going to pull everybody else up, or unfortunately the U.S. will be pressured down. It is too early at this stage to make a call on the long term, but it's not too early to make a call on the short term.
Now, these central banks, other central banks that are trying to spur on inflation, Mohamed, whether you're talking about, in England or in Japan and elsewhere, are they going to be able to meet their targets? Do you see that happening in the next 12 months, or are most of them going to miss their inflation targets?
So most of them will miss the inflation target. What they will succeed in doing is clipping the downside of a serious deflation. And that's what they're doing. Now, there are going to be consequences of that and unintended consequences of that. But I think that the market is going to worry less about significant deflation, but it's going to have to worry a lot more about the unintended consequences of very divergent monetary policy around the world.
And Mohamed, before we go, because we'll bring you back to talk more about what's happening around the world, but also the Keystone Pipeline. That news is happening in just a few moments, that press conference. But back here in the U.S. on the bond markets, I mean, you did see this enormous spike in Treasury yields, particularly on the shorter end of the curve. Is that something the Fed is going to have to worry about?
No, this is a natural consequence of the fact that it is highly likely that we will have the first rate hike in almost 10 years. What's interesting is if you look at the forward rates, the market is correctly anticipating a very gradual path of rate hikes and a terminal point that's going to be lower than historical averages. So I think what the Fed is seeing in both the spot and forward market is very much consistent with what it'd like to see. What it's going to be worried about is excessive volatility elsewhere, particularly in the stock markets around the world. That's what it's going to keep its eye on, because it will worry about spill back to the United States.